This lesson is called the four financial statements. In this lesson, you will learn to identify the four financial statements and know what they're called. You'll learn about the purpose of each statement, and then you'll learn to generate examples of decisions that people use these statements for and understand the types of information contained in each statement. This slide shows the four financial statements are the income statement, the balance sheet, which is sometimes called the statement of financial position, the statement of stockholders' equity, and the statement of cash flows. In the next few slides, we will go through each of these statements, talking about which information they contain and how you might use each statement. The next few slides have references to pages in your textbook, so if you don't have your textbook with you, you should go and get that before proceeding with the next slides. Let's start with the income statement. This statement is most commonly used by people running companies. It shows the amount of money the company has earned, called revenue, and the costs incurred to generate the revenue. The costs incurred are called expenses. In the most simple form, net income equals revenue minus expenses. It's exactly the same as your own personal life. Revenue is the amount you earn from your job, and expenses are the costs you incur to live that enable you to go to work and do the job. The purposes of the income statement are to show the kinds of revenue the company earns and the kinds of expenses the company incurs, not just the totals. What are the sources of revenue? What are the types of expenses? And then, does revenue exceed expense, or does expense exceed revenue? Let's move on to the balance sheet now. A balance sheet shows what the company owns. These are things called assets. What the company owes, how much they owe, the liabilities of the company are very important to most financial statement users. How much you own and what you owe and the difference between the two, equity, help users of the financial statements understand whether you're going to be able to pay your bills in the future. As you can imagine, if the amount you owe to others, the liabilities, is a lot higher than the assets that you have in your company, it's very likely that some of the people you owe money to will not get their money. So everyone's interested in a balance sheet's assets, liabilities, and equity. The other purposes are to show the types of assets you own, because owning a lot of equipment is very different than having only cash as an asset. Another purpose is to show the types of debts, because some types of debts are easier to repay than others. And to determine if assets are higher than liabilities, which means the company should be able to pay off its debts. Okay, so let's start to use a balance sheet by starting with the balance sheet for Bargain Electronics on page 72. On this balance sheet, we see that the list of assets and liabilities and equity is as of a specific date. This is December 31st, 2014. Balance sheets are always as of one specific date. Think of this, remember this most easily if you think about cash as being on a balance sheet. The amount of cash you have one day is different than the amount of cash you have on any other day. Might be more, might be less, but it's as of a specific date. You can also see from this bargain electronics balance sheet that the company owns cash and inventory and equipment among some other kinds of assets. And then you can see the company owes money for income taxes in the liabilities section, and the amount there is $7,200. Now let's talk about the statement of stockholder equity for a minute. This is one of the statements you learn to do in Accounting 202, so we don't do very much with it in our class, but you should know what it has in it because it shows some very interesting information. It shows the change in retained earnings, so it's a place where you can easily find out if the company had net income or net loss in a year. It also shows changes in common stock, which most frequently come from the company issuing more stock. In Accounting 202, you learn about all the different reasons that companies might decide to issue more stock, but the biggest of those reasons is the company needs cash. So ending equity in the statement of stockholder equity is ending retained earnings and ending common stock. Let's look at the statement of stockholder equity for Best Buy that's on page 56 in your book. This example statement does not show a date, but the statement always relates to a period of time because one of the elements of the statement is net income. So it shows the change in equity over a period of time. From this statement, we could see that the company issued stock in 2010 in the amount of $303 million, and the company paid dividends of $238 million in 2010. Most investors find those two pieces of information extremely helpful when deciding if they're happy with the way a company is performing. The statement of cash flows is another financial statement that you learn more about in Accounting 202 than you learn about in Accounting 201. The statement of cash flow shows where money gets its cash from, and that's very important to understand, that there are three basic activities a company does that can generate cash. Operating cash is operating the business of the company. If we produce shoes, we get cash when our customers pay for shoes. And we have cash expenses such as making the shoes we're selling. Financing cash, financing is borrowing. If we get a lot of cash from financing activities, it means we borrowed money. We took out loans from the bank. Investing cash could be from investments in the stock of other companies or could be in investments in our own equipment and so forth. So operating cash plus financing cash plus investing cash all create a cash change for the company in a year. And this special statement called the Statement of Cash Flows shows those sources and uses of cash. To use the Statement of Cash Flows, let's look at the Tootsie Roll Company Statement of Cash Flows on page 17 in the book. We can see from this statement that the time period for this Statement of Cash Flows ended December 31st, 2011. We can see that the company collected more cash from its customers than it paid to run operations. And this generates net cash provided by operating activities. We can also see there was an overall net decrease in the company's cash for the year of over $37 million. That's a lot of cash decline. This is the end of the financial statements lesson.